Good morning, my Eco 3311 students. Once again, we're back here now. We're starting to start talking about monetary policy, money supply creation. So the last time we recorded a lecture was about the institutional setup of the Fed. So we talked about the various agents of the Federal Reserve, what they do, ranging from the Board of Governors, the 12 district regional banks of the Federal Reserve. We talked about the Federal Advisory Council. We talked about the Federal Open Market Committee, which is one of the most important agencies of the Federal Reserve that conducts monetary policy. We saw that the FOMC meets almost every month and a half, about 8 times in a year in Washington, D.C., to decide whether or not to raise or decrease the federal funds rate, which is this interest rate that the Federal Reserve targets. And then we talk about the issues of the independence of the Fed, and we juxtapose the Federal Reserve independence with other central banks around the world, like the European Central Bank, the ECB, the Bank of Japan, the Bank of England. Okay, so today now we want to kind of continue with this discussion and start delving deeper and start talking about the money creation process. Okay, so you have to bear with me here. Let me share my screen. We'll talk about it on the other side. So here, this is chapter 14, which is the money supply process. Okay, so we are going to start talking. The preview of this chapter is kind of interesting too. This chapter provides an overview of how commercial banks create deposits and describes the basic principles of the money creation process. What you're going to learn when we teach you principles of macroeconomics, which is your first economics class, the 2315 class, we teach you monetary policy tools. We created an illusion because that's just an introductory class. We created an illusion in your mind that the Federal Reserve perhaps controls the money supply process 100%. But that's going to turn out not to be true. You're going to learn a lot in this chapter to realize that there are three key players in the money creation process. Of course, the central bank, the Federal Reserve, is one of the key players in the money creation process. And then the second entity is going to be depositors, like me and you, corporations, people who are depositing money in the banks, also play a big role. Because think about it for a second. If we Americans and our corporations go and withdraw all our money, or we show up at our bank location and withdraw all the monies from the banks, then the banks are not going to have the ability to lend funds, and that's going to jeopardize the money creation process. Okay, so the three players again, the Federal Reserve is going to be one of the key players. Then I talked about depositors, and then the third one is going to be financial institutions, right? Or you can call them depository institutions, banks. So all those three players are critical to the money creation process. And what we're going to do a little bit of math today in this chapter. And understanding the balance sheet of the Federal Reserve is critical to understanding how banks are going to create money when the Fed starts to execute monetary policy. Okay, so here are the learning objectives. We are going to list and describe the three players that we already talked about it. The three players in the money creation process, which I talked about, the Federal Reserve itself, depositors, and financial institutions like banks. And then we shall classify the factors affecting the Federal Reserve's assets and liabilities. And then we are going to identify the factors that affect the monetary base and discuss their effects on the Federal Reserve's balance sheet. Okay? So we talked about what monetary base is and discuss at length what the balance sheet of the Fed look like, and then how monetary base will affect the balance sheet of the Federal Reserve. Okay? And then we shall explain and illustrate the deposit creation process using T accounts of banks. This is going to be exciting. And then after we are all done with that, then we're going to start talking about monetary policy process and, talk about the money multiplier. Okay, so we're going to derive a complete model of the money creation process. Okay, so, and then we're also going to list the factors that affect the money supply, summarize how the three players can influence the money supply, and then calculate and interpret changes in the money multiplier as I talked about. Okay, so just to kickstart things here, I already mentioned it, that when we teach you principles of macro, we painted, an illusion in your mindset because that was your first macroeconomic class anyway. Baby, I call it a baby class. We didn't want to complicate things at that stage, but we created an illusion in your mindset that perhaps a central bank like the Federal Reserve would control the money supply process or the money creation process 100%. But it turns out not to be true. Okay, as I say, there are three players. Of course, the central bank itself, which is a Fed for the United States, and then banks, which we're calling depository institutions or financial intermediaries. And then with depositors, people who are depositing, individuals and institutions and corporations that are depositing money in their bank, okay, also play a critical role in the money creation process. Okay, so the first thing I want to talk about in the previous chapters, chapter 9, when we were talking about management of financial institutions, I shared with you and we talked at length about the balance sheet of a regular private bank or commercial bank, how it looks like. And we did a lot of balance sheet entries. We did a lot of ratio analysis, okay? What you're going to learn today, we're going to start by talking about the Federal Reserve of the balance sheet of a central bank like the Federal Reserve. You're going to soon learn that of course, there are going to be a lot of differences, stark differences between the Federal Reserve's balance sheet and the balance sheet of regular commercial banks, okay? But there are going to be some connections, how changes in the Federal Reserve balance sheet could impact regular commercial banking activities or their balance sheet. So let's talk about it. So let's talk about the balance sheet of the Federal Reserve. Okay, but before I kind of like omitted something here. There's some elements that I omitted from the balance sheet, but I want to talk about them in general. Just bear with me for a second. So typically when we talk about a balance sheet, we want to understand the assets. Okay, so when we talk about the balance sheet of a central bank, like the Federal Reserve. So anytime when you hear me talking about the Fed, that is my acronym or short form for the Federal Reserve System. The Federal Reserve. So let's discuss briefly the assets of the Fed. What constitutes as assets on the balance sheet of the Federal Reserve? So the first asset of the Federal Reserve, we talked about in chapter 9 when we are telling you of the management of financial institutions. The Fed is the bankers' banks, okay? That means all banks in the United States deposit their money with the Fed. And then the Federal Reserve also gives loans to banks, right? What we call discount loans, okay? So we're going to call, so any loans to financial institutions by the Federal Reserve is going to be its assets. Loans to financial institutions. Okay, that's an asset of the Fed. The Federal Reserve can lend money to Bank of America, to Citibank, those banks that we talked about the other day. So the Fed is a banker's bank. It can lend funds to private banks in the nation. So loans to private banks is an asset of the Federal Reserve. It's an investment by the Fed. So it's their asset. And then the second asset of the Federal Reserve, the Fed is the custodian of government debt. The Federal Reserve invests a lot in U.S. Treasury bonds, okay? And they use those Treasury bonds to conduct monetary policy. So down the road, we're going to talk about how the Fed is going to make changes on its balance sheet, whether selling or buying more bonds to influence the supply of dollars in the economy and interest rates, okay? So when the Fed invests in Treasury bonds, the Fed earns interest payments, just like banks. Banks also do invest in Treasury bonds. We saw that at the time, Treasury securities. So we can say securities. When I say securities, I mean mostly what? Comprised of bonds. Treasury bonds, for the most part. So those are the two main assets of the Federal Reserve that we care a lot about as monetary economists. But I'm going to add one more, which then I will not include eventually when we start like doing like actual balance sheet, whatever analysis. But you know that is going to exist. So The third item here is going to be what we call foreign currency reserves. So what are foreign currency reserves? The Federal Reserve, just like any other central bank, is going to keep a ton of other countries' currency as its reserves, okay? So the Fed is going to hold a ton of Japanese yen. The Fed is going to hold a ton of the UK pound sterling. The Fed is going to hold a ton of Mexican peso. The Fed is going to hold a ton of, say, the Chinese yuan, the Chinese currency called the yuan. The Fed is going to hold a lot of the Canadian dollars. Okay, other major currencies around the world, the Fed is going to hold a lot of the euros. Okay, so they're going to keep. So when you ask me, why does a central bank like a Federal Reserve keeps other countries' currency at its disposal? It's very important that you know this. Okay, we talked about that. The value of the US dollar against other currency, what we call the exchange rate, is critical. Okay, if the dollar loses value, what they call depreciation, okay, first of all, that is good for US exports because US goods become cheaper in the rest of the world, to the rest of the world. But if the dollar gains too much value, what they call appreciation of the dollar, that can be detrimental to the United States in terms of its exports to the rest of the world because US goods will be more expensive. So here's why the Federal Reserve is going to keep a bunch of other countries' currency. First of all, the US central bank does not intervene regularly on the foreign exchange market or the currency market, the market where we sell foreign currencies, where there's buying and selling of foreign currencies. Okay, the Chinese central bank still does a lot of intervention. They fix the value of the Chinese yuan and they won't allow it to appreciate, or you know what I mean? Within a certain bound, the Central Bank of China is going to intervene and make sure. Okay, so here's the deal. For the United States, if the dollar depreciates like say 1, 2, 3, 5%, even up to 10%, the Federal Reserve is going to let that go. But I have to be honest with you. Let's say if we wake up tomorrow and the dollar depreciates by 60%, we see 40% of the value of the dollar is wiped out. Trust me, the Federal Reserve is going to intervene to bring back the value of the dollar where it was before that depreciation, before the dollar loses value. Okay? So, first of all, what do we mean by depreciation of the dollar? I know some of you might be, sometimes these things sound abstract, okay? So let's say, you just pick a dollar against one currency. Let's say $1 today equals to, say, let's just say 10 Mexican peso. Okay. And then let's say tomorrow, when we wake up tomorrow, could be next year or next month, $1 now buys only 5 peso. Today, one US dollar can be exchanged for 10 Mexican pesos. But now we wake up tomorrow and $1 now can buy only 5 peso. This is what we call a depreciation in the dollar. The dollar has lost value against the Mexican peso. And this is a lot because this is like more like what? The value of the dollar almost has been cut in half. So 50% wiped out in the value of the dollar when you think about it. Okay? So dollars lost 50% of value. In this case, the Fed is going to intervene. Because the Fed hold a ton of Mexican peso at its disposal. You hold a ton. So, and chances, anytime the US dollar is depreciating against one particular currency like the peso, it is also possible that it will be depreciating against other currencies like the yen, like the Chinese yuan, like the euros or the UK pound sterling. It's very possible that a depreciation of the dollar against a single currency like the peso might also imply that the dollar would be losing value against other foreign currencies. Okay, so what can the Federal Reserve do with its currency reserves to bring the dollar back close to where it was before this depreciation, bring it back to $10? Sorry, 10 peso per dollar. So in this case, the Fed needs to what? The Fed needs to dump. The Fed is going to sell foreign currency reserves. It's going to sell like the Mexican peso, dump the peso in the market, use its currency reserve, the peso, to buy the dollars of the market. So the Fed is going to intervene in the foreign currency market, in the currency market, a market where we trade foreign currency, and sell a lot of Mexican peso, meaning that they're dumping, they're going to supply more peso in the marketplace while buying the dollar. If they buy the dollar off the market, that means there's going to be limited dollars available. That's going to help the value of the dollar to appreciate back to a dollar equals to 10 peso. That's the importance why they keep that foreign currency reserves. And then the converse is true. What about if what? What about if the dollar had appreciated? We woke up instead and the $1 was buying 20 peso. Okay? If we jump from 10 peso per dollar to 20 peso per dollar, that's also bad. This is what we call, if we move from here to here, that's what we call an appreciation in the what? The dollar's appreciated against the peso. Appreciation of the dollar. Okay? And keep in mind, when I say the dollar is appreciating against the Mexican peso, it means the peso is depreciating. Okay? That's what it just means. Okay, so, and as again, I said before, when the dollar is this large appreciation of the, appreciation, I made a big mistake here. So it's okay. This large appreciation of the dollar basically means that what? U.S. goods are going to be more and more expensive, because for Mexicans to be able to buy U.S. goods, they need U.S. dollars. Okay, initially, every 10 peso that they would have would buy a dollar. But now Mexicans need 20 pesos to buy the same $1. Okay, so the dollars gain value, and this is not going to be good for U.S. exports to Mexico, meaning that it's going to affect international trade. We cannot sell a lot to the rest of the world when the dollar becomes more expensive. People cannot afford it. So the Fed is going to act this way too. They need to bring the value of the dollar back to what? To near $10. So in this case, the Fed is going to buy Mexican pesos using dollars. They're going to dump a lot of US dollars in the marketplace to buy the peso. In that case, the US is going to the Federal Reserve is going to accumulate more Mexican peso in its reserves, meaning that is going to help depreciate the dollar back to where it was about 10 peso per dollar. So that's the importance of why we need that. So that is on the balance sheet. But when I'm going to write the formal balance sheet of the Federal Reserve, we are going to exclude this because we rarely use this in actual, balance sheet entries. But it's something that you should realize that it exists. Every central bank keeps a ton of what? National foreign currency reserves. Sometimes they also keep gold as a form of reserves. Okay? So gold, foreign currency reserves are kept by every central bank. Okay. So now, that is the asset side of the balance sheet of the Federal Reserve. So we need to talk about the liability side too. And the liability side also, there are two main items that we care about, but I'm going to add a third one, which when we're doing the actual transaction, we're just going to disregard it. So let's talk about liabilities of the Federal Reserve, of the central bank. So the key elements on the liability side of the balance sheet are going to be things like reserves, which we can denote as R. Remember, reserves, as we discussed in chapter 9, they are bank deposit with the Fed. All banks in America are required to open an account with the Fed, to deposit their monies with the Fed. Me and you and corporations, we have got nothing to do with the Fed. We don't have an account with the Fed. We are not allowed to open an account with the Fed, but banks do. Okay? So the Federal Reserve is not the public's bank, it's the banker's bank, meaning that all banks open an account with the Federal Reserve, and that account that they open with the Fed is what we call the reserve account. So meaning that these are bank deposit with the Fed. This is not the Fed's money. These are banks' money, private banks like Bank of America depositing their money with their account with the Federal Reserve System. That's why we're going to record it as a liability. Just like we saw in chapter 9, when you deposit money in Bank of America, That is not Bank of America's money. That's why we said when private banks like Bank of America are going to record customer deposit, both what? Transaction and non-transaction deposit, like checkable deposit, savings account deposit, certificate of deposit. Those are recorded as bank liabilities because those are not the bank's money. They're your deposit with your bank. That's going to be the same thing here. These are the bank deposit with the Fed. So the Federal Reserve is going to record those as a liability item on its balance sheet. And then the second element on the liability side of the balance sheet is currency in circulation. We're going to denote as C. Okay? So the Fed is liable because the Fed is the one that print money. Okay? They're liable for every dime. And this for us to record currency as a liability to the Fed, this comes with history. Because when you go back in the 17th century, the 18th century, during the classic gold standard, under the gold standard, you remember, and the gold standard came until around war period time. We abandoned it, but then we revived it after the Bretton Woods, after 1944. After when World War II was coming to an end, we revived the gold standard. The gold standard basically says that the main price of gold for any country must be tied to the US dollars. In other words, the dollar is backed by gold. Okay? So every country would declare the main price of their what? Of their gold in terms of their currency. For example, the United States would say $40 would buy you 1 ounce of gold. So that means whoever was printing the money, you would not print money if you did not have enough gold to back it up. So that made the central bank liable for any currency it prints and disposes of to the public. That makes sense? So currency in circulation, because it's printed by the Federal Reserve, is a liability of the Fed. So I'm going to add the third item, which you just need to know, but we're not going to be using it to understand balance sheet entries on the Federal Reserve, accounts. And that is going to be U.S. Treasury deposit with the Federal Reserve. Okay. So when the United States government collects all these tax revenues, let's say they collect $4 trillion in tax revenue in 2025, where do you think American government deposit that money? The U.S. Treasury. The United States has an account with the Federal Reserve, where they deposit government money. So we call it U.S. Treasury deposit with the Fed. So that means if America collects large sums of tax revenue, that means the liability of the Fed is going to go up because that's U.S. government deposit. So it turns out there are only two entities that can open an account with the Fed: banks through their reserve account, and then the U.S. government. But we, the public and corporations, we have got nothing to do with the Fed. Me, you, and corporations we do not have a direct account open with the Fed. Okay, so now. And again, on the liability side, we are going to kind of ignore this third item, but you just remember that is a liability of the Fed because it's not very important in understanding the balance sheet. So we're just going to assume loosely that the liability side of the Federal Reserve balance sheet consists of reserves and currency. Meanwhile, the asset side also, we drop one item, it's just going to be loans and securities. But remember, foreign currency reserves is part of the what? The Federal Reserve balance sheet. Okay, so that's why the balance sheet of the Fed then looks like this. So we dropped one item on the liability, on the asset side, which was what? Foreign currency reserves. And then we also dropped one item on the liability side, which is what? In Treasury, U.S. Treasury deposit with the Fed. So we're only going to have two items on the liability side and two items on the asset side. This is the key to understanding the balance sheet of a central bank. Okay, so currency in circulation in the hands of the public is a liability. Reserve, these are bank deposit at the Federal Reserve and vol cash. We talked about this in chapter 9. And then assets of the Fed include government securities, like holding by the Fed that affect money supply and what? And interest. So the Federal Reserve is a custodian of the U.S. government debt. They invest a lot in U.S. Treasury securities, Treasury bonds. Okay. And then, of course, I talked about discount loans. Loans to financial institutions are called discount loans. So the Fed provides reserves to banks and earn the discount rate, right? The Fed can give overnight lend overnight reserves to banks or loans to banks and charge what we call the discount rate. We talked about that in chapter 9 as well. Okay, so now let's start talking a little bit more about balance sheet entries. But before I talk about balance sheet entries, the right-hand side, so I said our notation for currency in circulation, total money that is, which is not within the banking system, but circulating with the public. Like when you think about money that you have in your pocket, in your wallet, I don't know how you keep your money, whether you dig a hole in your backyard and store your money there, or you keep it under the mattress at home, or in a piggy bank at home. Depending on how your family stores money. I'm talking about money which is outside of the banking system, which is circulating with the public. That's what we're calling currency. It includes all US dollar bills out there and coins. Okay, all pennies out there. So currency in circulation with the public, we denote that as C, and then reserves, total reserves in the banking system, we're going to call it R. So the right-hand side of the Federal Reserve balance sheet is what we call the monetary base. That means the sum of currency and reserves, these two items on the liability side of the balance sheet, there are two, you can call it, okay, we call those the monetary liabilities of the Fed, but they have a special name. Okay, so the monetary base is also called what? High power, depending on the textbook you're using, they mean the same thing. The monetary base or high powered money is the Federal Reserve, the liability components of the Federal Reserve, which comprise of currency in circulation plus reserves, which you're seeing on this balance sheet, these two items. Okay, if you don't want to call it monetary base or high powered money, you can also just call it the monetary liabilities of the Fed. Monetary liabilities of the Fed consist of those two things. Okay, so our notation for MB and monetary base is MB, monetary base equals to currency plus reserve. We can just say high-powered money equals to currency or monetary liabilities. They mean the same thing. You can use those terms interchangeably to mean the same thing. Okay, so now let's start doing some balance sheet and entries here. Okay, so we teach you in principles of macroeconomics about tools of monetary policy, the tools that the Federal Reserve will use to influence the supply of dollars in the economy. So let's tell, and now I'm going to tell you guys, talk about it here with reference to the balance sheet. So we're going to actually, for example, when we tell you in principles that the Federal Reserve buys bonds, then we tell you that leads to an increase in money supply. We don't show you directly how that actually impacts the balance sheet of banks, and that affects the balance sheet. And where is the Fed buying these bonds from? We need to understand that. Okay, so let's delve in. So let's start talking about tools of monetary policy. I'm going to talk about tools that directly affect the monetary base first, and then later on, tools that will affect mostly just this monetary base. Then later, we're going to talk about, introduce the topic, the money multiplier, because there are some tools of monetary policy that are not directly tied to the monetary base, but they will affect the what we call the money multiplier. Either way, whether you influence the money multiplier in the system, we still don't know what money multiplier is. I'm going to break that down for you, shortly. Or you are influencing the monetary base directly. All of those are going to have a bearing on the what? On the money supply overall. Okay, so we teach you in principles of macroeconomics, your first economics class, which you took in your freshman year, that when the Fed wants to include the most important tool of monetary policy that a central bank like the Fed, that it uses to influence the supply or the stock of dollars in the economy and interest rate, is what we call the open market operations. This is the main tool of monetary policy. So what is open market operation? This is buying and sometimes selling treasury securities. We could just say treasury securities by the Fed. Okay. Now, the question is, if the Fed, a bond, when I say treasury bonds, treasury securities are bonds. Treasury bonds, you can call it treasury securities, treasury bonds. A bond is an OU document. It's just a piece of paper. So when I buy a piece of paper from you, something called bonds, okay, that means I'm taking away this piece of paper from you because I'm the one buying it, but leaving you with money. So think about it. If the Federal Reserve buys these pieces of paper from the what? From the public. Remember, we the public, we don't have an account with the Fed. That means the Fed has got two choices. It will either pay for this by writing us a check, or the Fed can use cash, just pay for it using cash. Then the Fed is going to print money to buy those bonds. That's how money supply is going to go up, because money supply in the economy includes currency in circulation. So I'm going to talk about a couple of ways the Fed can influence the what? The supply of what? Reserves in the banking system, or currency, and currency, and then how they affect monetary base. Okay, so the first, let's talk about the first one. We're going to start doing something, so be ready here. So example one. I can say example A. We say, suppose the Fed, the Federal Reserve, I'm just going to be abbreviating as a Fed, conducts a $100 million bond purchase from banks. A $100 million bond purchase from banks. Then I say, Roman 1, use the balance sheet, like the T account, approach to show how this impacts reserves and the monetary base. Reserves in the banking system and the monetary base. So the Federal Reserve went and bought $1 million of treasury securities or treasury bonds from US banks, US private banks, commercial banks. So now we need to, so it's very easy. So let's look at the solution. So there are two parties involved here. There is the banks, private banks, and then we have the T account or the balance sheet of the Federal Reserve. Okay. Each account, each bank entity has got what? You record assets on the left and liability on the right. We want to see, and then assets on the left here for the Fed and liability on the right-hand side. So with the first start, what I want to let you guys know at the very beginning, I want you to know that before this transaction happened, because a balance sheet, whether for the Federal Reserve or for banks, is a double accounting entry where a transaction enters a debit and as a credit, and a balance sheet must always balance. So the presumption that we're going to have here is that even before this bond purchase took place, the bank balance sheet was balancing, and the Federal Reserve balance sheet was also balancing. Okay, so now we've been told the Fed has purchased $100 million. That's called an open market purchase by the Fed, means the Fed is the one buying. The Fed has bought $100 million worth of treasury securities or treasury bonds from banks. Traditionally, if you buy something, because a bond is an asset, a treasury security, if you're the one buying it, you gain it. So since the Fed is the one buying, the Fed is going to see its asset, which is securities or treasury securities. Okay, I don't have space here. Its securities is going to increase by what? Plus $100 million. So I'm calling it plus $100 million because The Federal Reserve already had Treasury security on its balance sheet before that. I want to make this clear. This is not looking very clear. Now, I want to be neat so that you don't confuse doesn't confuse you a lot. Let's do this. Okay. So we want to find out the impact of that $100 million bond purchase. So let's say this is a balance sheet of banks, the T account of banks. And then this is a T account or the balance sheet of the Federal Reserve. It's writing for the Federal Reserve. Okay. So we're saying these assets of the bank are going to be recorded here and liabilities of the bank are going to be recorded on the right-hand side here. You know the drills. And then assets of the Fed are going to be on the left-hand side and then liabilities on the right-hand side. And as I said, before this bond purchase happened, we're assuming that the balance sheet for both Federal Reserve and banks were balancing. Now, if the Fed buys $100 million worth of securities, that means the Fed gains something. You buy something, you gain it. So Treasury securities is going to increase by $100 million. So you put plus $100 million, meaning that that's not the only security that the Federal Reserve has on its balance sheet. The Fed already had a bunch of Treasury security on its balance sheet, maybe worth $1 trillion. But when they choose to buy $100 million more, it is just add on to their existing asset securities that they already had. Okay, now the Fed is buying these securities from banks. If I buy something from you, you lose it because you're there. So the banks are the ones selling securities to the Fed. And when they sell their securities to the Fed, you sell something, you no longer have it. So the banks are going to see their securities go down. So you have to debit their security negative $100 million. Why? Because they sold them to the Federal Reserve. The Fed gains it. Okay, now I want you to be very careful here. In a normal transaction, if I buy something from you, I need to either write you a check or pay for it using currency. Now, here's very interesting. Banks already have an account with the Federal Reserve. The bank's account with the Fed is what we call reserve account. Reserves are bank assets. We saw that in chapter 9. While reserves, because reserves are bank deposit with the Federal Reserve. It's just like you, if you deposit money with your bank, that is your assets. So reserve, so if you deposit money with your bank, you are going to record it on your balance sheet. As that is your asset, your deposit with your bank. But your bank is going to record that as a liability because that's not the bank's money. That's the same thing here. Banks have their deposit with the Federal Reserve called reserves. So while reserves count as bank assets, they're actually going to count as the Federal Reserve liabilities. So reserves are part of what? The Federal Reserve liability. We saw it already. Okay, so now let me go back. So I said in a normal transaction, if I buy something from you, I need to write you a check or pay for it using currency. So in this case, the Federal Reserve need not write a check or pay for this transaction using money. Why? Because banks already have an account with the Federal Reserve called their reserve account. So when the Fed buys something from banks like Bank of America, the Fed doesn't need to write a check to Bank of America. The Fed is just going to credit Bank of America's reserve account with the Fed by the actual amount of the purchase, and the transaction is complete. Monetary policy is almost like a click of the pen, a click of the mouse. That's what it is. So the Fed is going to credit the bank. So banks are going to see their reserves, which are their deposit with the Fed, goes up $100. That's $100 million. Okay? And while reserves are the bank assets, the Fed will see its liability, monetary liabilities, go up by what? $100 million. And this is how the balance sheet you're going to illustrate, and that's complete. So if the balance sheet of the Federal Reserve was balancing before the Fed conducted that open market purchase, it should still balance. Why? Because on the left-hand side, on the asset side, we added something worth $100 million, and on the right-hand side, we also added something $100 million. So the balance sheet will continue to balance. Meanwhile, for the balance sheet of the bank, if the balance sheet of the banks were balancing before this transaction occurred, it should still balance. Why? we subtracted something from the asset side worth $100 million. Then we turn around and added something on the asset side worth $100 million. So they cancel out. So you will not affect the balancing of the balance sheet, because we subtracted something worth $100 million on the asset side and added $100 million on the asset side. So, they offset each other, so that if they were balancing before, the balance sheet should still balance. Asset sides must still be equal to liability side. Okay. And then, so now we have been told to show how reserves and monetary base will change. So we now know that, we remember reserves, the notation for reserves, we give it was R, right? But we want to look at the change. So delta here means change. I want the Greek letter of the alphabet, delta, in my class. I already told you, when I say delta R, that means change in reserves. So you can see that reserves has clearly increased by what? $100 million. And then what about the monetary base? We know that the monetary base is a sum of currency plus reserves. We talked about that already. The monetary liabilities of that ratio. Then we have to express this in change. So that means change in the monetary base can be brought about when you change either currency or you change the reserves. But in this case, it's only the reserve that is changing by 100 million. We talked about that. So that means currency has not changed. So that means the change in the monetary base is going to be $100 million. That's it. That's one example. It's very exciting to basically learn how to do this balance sheet entries on the Federal Reserve's balance sheet. So it's very, very important. Okay, so we're going to do another example here, which is this was about $100 purchase from banks. Okay, so let's talk about what about if the Federal Reserve had purchased these treasury securities from we, the members of the public, we, the non-bank public. How would you record this transaction on the balance sheet of the non-bank public and the balance sheet of the Federal Reserve? So let's do another example here. Okay, so example B. So let's say, suppose the Fed, you see again, our short form for the Federal Reserve is the Fed, conducts a $100 million bond purchase from the non-bank public. Okay, and pays for it, by writing a check. Okay, so now I mentioned at the beginning that we, the members of the non-bank public, me and you and corporations, we don't open an account with the Federal Reserve, but banks do. The Federal Reserve, the U.S. Central Bank, is a banker's bank, meaning that it's only banks and maybe U.S. government, the Treasury, who are allowed to deposit money with the Federal Reserve. But me and you, the members of the public, what we call the non-bank public, and including corporations, we don't have an account with the Federal Reserve. We have an account with our private banks like Bank of America. So what does that mean? That means if the Federal Reserve buys something from us, okay, the Fed must either pay for it by writing us a check or use currency, pay for it using cash. This example is saying that the Fed decides to pay for this transaction by writing a check. Okay, so now let's see, even though you see the Fed is buying these bonds from the non-bank public, banks are not involved, but the banks are going to be involved anyway. Okay, because if the Federal Reserve writes a check, let's say you're the one, Peyton was the one who received $100 million check from the Federal Reserve because the Fed bought $100 million worth of treasury bonds from Peyton or his company. So Peyton is going to deposit that check into his account, because after you get a check, you don't just put it under the pillow. You have to deposit that check into your private bank like Bank of America, and that check is going to clear at some point. So even though the banks are not going to be, it looks like it's no, you don't see bank in this question, banks are going to be involved. So there's going to be three parties involved in this transaction. So let's look at how the balance sheet of the banks, the Federal Reserve, and the non-bank public is going to change. Okay. So I'm going to illustrate here the T account of, let's say this is the balance sheet of the non-bank public. It could be, when I say non-bank public, that could include could be either corporation or just regular folks. And then we also have to, we're going to show what happened to the balance sheet of the Federal Reserve after he conducted that bond purchase. And then we must also show what happened to the T account of banks. Because as I told you, even though banks were not involved in that problem, they are going to be involved through check process. Okay, so I guess I say, everybody on the left-hand side of a balance sheet, we record assets. We record liabilities on the right-hand side. You know the drill. Same with banks. We are going to have assets on the left. We're going to have liabilities on the right. Same with the non-bank public. They have their assets here. They have their liability here. Okay, so let's see. So, and we're assuming that before the Fed conducted that bond purchase of $100 million from the non-bank public, okay, the balance sheet of the non-bank public was balancing, meaning that assets must equal to liability. Because a balance sheet is a double accounting entry. Again, transactions end as a debit and as a credit, and it must always balance. So we're assuming that before that transaction happened, balance sheet of all these three entities were balancing. And then all of a sudden, the Fed bought $100 million worth of treasury securities or treasury bonds from the non-bank public, meaning that the Fed is the one buying. If you buy something, you gain it. So the Fed is going to see its treasury securities go up by, so we're going to add $100 million because they bought. It does not mean that this is going to be the only securities that Fed has on its balance sheet. The Fed already has trillions of dollars, but when they choose to buy $100 million today from the non-bank public, they're just adding onto their existing assets, their existing securities. That's why we need to write that as plus $100 million. They will see their securities or treasury bonds go up $100 million. Meanwhile, who is selling those securities to the Fed? We have been told clearly in the problem that the Fed conducted an open market purchase from non-bank public. And traditionally, if you sell something, you lose it, you no longer have it on your balance sheet. Because they're the ones selling, we are going to debit their securities by $100 million. So this negative $100 million. Okay? And then what has happened here? The Fed did this by writing a check. That's what we've been told in the problem. The Fed bought this pays for this transaction by writing a check. So when the members of the public receive a check, this is exciting. When they receive a check, they are going to deposit that check into their account with their bank. Maybe this member of the public has got an account with Bank of America. So there's going to be a check deposit of $100 million. That is going to be their asset. They're going to see their asset deposit go up $100 million. Okay? And we have seen in chapter 9, anytime, okay, so this bank, so here, we know that what do we call bank deposits? Bank deposits are what? Deposit made in a bank is not the bank's money. The bank, while this shows up as your asset, as a member of the public, once you deposit a check into your bank is going to record it as a liability. So deposits are bank liability. We saw that in chapter 9. We're going to go up $100 million. And as we're saying, anytime you deposit money in a bank, bank reserves are going to go up by the same amount of the deposit, because banks now have $100 million. Once that check clears, the banks already have now vol cash of $100 million. Vol cash, whether the banks choose to deposit with their account with the Fed or stays as vol cash, is the bank asset. Now, because a balance sheet is a double accounting entry, transaction must end as a debit and as a credit. While you deposit a check at the bank of $100 million, the bank reserves will eventually increase. Once that check clears, it's going to increase by $100 million. Bank reserves are bank assets. But while reserves are bank assets, they are the Federal Reserve liability. See? So So the Fed is going to see its reserves go up, or its monetary liabilities going up by $100 million. And that is complete. That's how you enter this transaction in those three balance sheets. So if the balance sheet of the non-bank public was balancing before, it should still balance. Why? Because on the asset side, we subtracted something worth $100 million, but we turn around and added something worth $100 million. So they cancel out, they offset each other, leaving the balance sheet to balance still. On the Federal Reserve balance sheet, we added something on the asset side worth $100 million, security, because they bought securities, they gained assets. But we also have to add something worth $100 million called reserves. The balance sheet of the banks, there's an increase in the monetary, so in the liabilities of the bank of $100 million, but they also have an equal increase of assets, reserves, $100 million. Then the transaction is complete. So also in this case, now you can see the change in reserves, because our notation for total reserves is R, right? Reserves stand for R. So delta R means change in R. Change in reserves is going to be equal to $100 million. But I say the monetary base consists of, which is a liability side or balance sheet of the Fed, consists of currency plus reserves. So the change in the monetary base must equal to change in currency plus change in reserves. In this case, it's a reserve component that has increased by $100 million. Therefore, that means that's going to trigger an equal increase in the monetary base of also $100 million. Okay? So that's how you enter that transaction on the balance sheet of the Federal Reserve. Okay, now I want to do a slightly different case. Okay, so another example on this same bond purchase. Okay. What about if the Federal Reserve had paid for this? Because remember, if the Fed bought these treasury securities from we, the non-bank public, and it paid for it using what? By writing a check. What about if the Fed paid for these securities using by what? Okay, so let's do example C. So suppose the Fed purchased $100 million of securities or treasury securities from the non-bank public. Same example, from a non-bank public. But in this time round, non-bank public, and pays for it, and pays using currency, meaning using cash. Okay. Okay. This is one, or you could say, and this is another way of saying it, or the Fed could have paid. This is another way of saying that, or they paid using check, paid using a check, but the non-bank public cashes the check. That's the same thing. Non-bank public cashes the check. You guys know that check cashing places all over America. You can cash your check and that check never makes its way to the bank. You know that. So when I say paying for it using card is the same thing as saying the Fed could have actually paid for it in the first place using check, but whoever received that check decided to cash the check. Okay, that means the same thing. So now, because the Fed, so there's going to be currency involved here. Okay, so here we're going to say draw the bar. So in this case, because the Fed is paying for this transaction using currency, the bank is not going to be involved. So it's just going to have, we're going to have just a balance sheet of the what? Of the non-bank public here. And the balance sheet of the Federal Reserve. Banks are not going to be involved in this case. This is the Federal Reserve balance sheet. Again, as usual, we must always have assets here on the left and liability on the right-hand side of that T account. Same thing here, liability on the right-hand side of the bank or the non-bank public balance sheet, and the asset on the left-hand side. So as usual, the Fed purchased $100 million worth of securities. That's not going to change. That's still going to be as before. Securities of the Fed will go up $100 million. And then the assets of the non-bank public, because they sold their securities to the Fed, we're going to debit this asset by $100 million. Okay. Now we are saying that the Fed decided to pay for this currency by what? Pay for this by using money, currency. Remember, the Federal Reserve is the one that prints money. So that means the Fed, the liability of the Fed, because currency is a liability of the Federal Reserve balance sheet. So currency in circulation, because the Fed needs to print money to pay for these bonds that they're buying from a non-bank public, we're going to see currency in circulation go up by $100 million. While currency is the Federal Reserve liability, they're printing that money and giving it to the non-bank public because that's how they're paying for it. So while these people have lost their securities, but they will gain an equal amount of what? Of cash. Equals to $100 million positive. That's how the balance is going to look like. So now in this case, the change, there's no reserve. So the change in reserves in this case is going to be zero because but the change in currency is going to be $100 million. So that means the change in the monetary base, which is always given as a change in currency plus change in reserves, okay? We know it's the currency component which is changing this time by $100 million. So but regardless, the monetary base is still going to go up $100 million. So what have we learned under the three cases? We did three cases here. The first case was the Federal Reserve conducted a $100 million bond purchase from banks, okay? And we illustrated it here because they were buying this from, let's say, the Fed buying treasury bonds from Bank of America. So the transaction between the Federal Reserve and banks. So in that case, see, the securities of the Fed went up because they bought it. Banks were selling it, so they lost it, okay? But because banks already have an account with the Federal Reserve called the reserve account, when the Fed buys something from banks, the Fed does not need to write a check to the banks or pay for it using currency. The Fed is just going to credit the bank's account with the Fed called reserves by the actual amount of the purchase. So your banks are going to see their reserve, their deposit with the Fed go up 100 million. It's just like you and me. If your bank buys something from you, let's say you have $10,000 in your account right now, in your checking account, and your bank buys something from you. Your bank doesn't, let's say worth $500. Your bank doesn't need to write you a check anymore. Why? You already have your account with your bank. The bank is just going to add onto your $10,000 more $500. So you'll see your account with your bank, your checkable deposit go up by $10,500. That's the same thing here. Because banks already have an account with the Federal Reserve. All banks in America deposit their money with the Fed. That deposit is what we call reserve. So when the Fed buys something from banks, okay, we know the banks are loose. This is how we're going to enter this on the balance sheet. The bank is the one selling. You sell securities, you lose it. But the banks are going to be credited with what? Their reserve account with the Fed is going to be credited by $100 million. But while reserves are the bank assets, they're the Federal Reserve liabilities. That's why the liability of the Fed is going to go up $100 million. So in this case, it is the reserve component of the monetary base that is changing. The second case too, when the Fed bought these treasuries bonds from the non-bank public by writing a check, is similar because, you know, the check, these guys are going to receive the check and deposit that check into their bank. So you're going to see that checkable deposit, which is their asset, go up by $100 million. And then that money entered. Once the check has been deposited to the bank has got an equal amount to reserve because of $100 million. So in this case too, the reserve component is the one that goes up. Reserves are going to go up $100 million. But overall, the monetary base is going to go up. And then, but the last case, because the Fed paid for this transaction using currency, there's going to be no change in reserves. It's the currency component of the monetary base that is going to go up by $100 million. So what have we learned under three cases? Okay. So the effect of an open market purchase by the Federal Reserve, okay, on the monetary base, in all three cases, the effect of an open market purchase, when the Fed buys something, whether it is buying it from banks or buying it from the non-bank public, the monetary base will always increase by the same amount of that purchase. Okay? In this case, they were buying $100 million worth of treasury securities. whether they did buy it from the Fed, from banks or from the non-bank public, we have seen that in all cases, the monetary base goes up $100 million. Okay? But the effect of open market purchase on reserves depends on whether the recipient of the check the recipient of the check from the Fed cashes the check or leaves it as what? As deposit with their bank. We saw that. If the person who is selling that securities to the Fed cashes the check, the impact of open market purchase will have zero effect on reserves. So meaning that the effect of open market operation or purchase, bond purchase by the Fed is uncertain on reserves. Reserves can either go up or doesn't change at all. But the impact is obvious on the monetary base. The monetary base will always increase by the same amount of the bond purchase. So I made those summaries here. So these are what we have been talking about now. This is a first case where the Fed was buying these bonds from banks. We did that already. That's how we did it. I was writing it down. In this case, the monetary base, like here where we say the change in the monetary base is going to be $100 million. But here, change in reserves, we can just write delta R is $100 million. Okay, that's the first case. Second case is where the Fed bought the bonds from the non-bank public, from we, the members of the public. Okay, so here, when the Fed wrote it, in this case, on the PowerPoint slide, I did not draw the balance sheet of the non-bank public, right? But they because they're buying this from a non-bank public, I did that in more detail when I wrote it on the board. That's the same example that I have here. Let's go back. This one. So you have to, I have 3 balance sheet here. But on the PowerPoint slide, I only show you the balance sheet of the Federal Reserve and banks, because that check eventually is going to be deposited in the bank anyway. But for completeness, you need to know what happens to the balance sheet of the non-bank public who sold their securities to the Fed, because the Fed was buying it from them in the first place. Then they deposit a check to the what? To their banks. So he actually showed it in more detail. On the PowerPoint slide, in that case, I showed just what? 2 balance sheet, because a check got deposited in a bank. And then there's a case where if the person selling securities to the Fed cashes the Fed check, that's the same thing as saying the Federal Reserve pays for these securities using currency in the first place. Okay? Because when the check was cashed, that check, there's going to be an increase in money supply in circulation. So currency is going to go up. The securities is going to be the balance sheet of the non-bank public. So in this case, currency in circulation is the one that increases, but there's no change in what? Reserves. Now, that's what we say. The last case we did, change in reserve was 0. But change in currency component equals to $100 million. But regardless, the change in the monetary base is still going to be $100 million. So the monetary base always increases. I want to make this again very clear. It always increases by the same amount of the bond purchase. And I'm going to do another example. And it also decreases by the same amount of the bond sale. If the Fed was selling bonds, monetary base would decrease by the same amount of the open market sale. Okay. So here's a summary, that which I already talked about. The effect of an open market purchase on reserves depends on whether the sale of the bond keeps the proceeds, like the check they're receiving from a Fed, in terms of currency, or they deposit the check in the Fed with their bank. If the check gets deposited with their banks, then the effect of the bond purchase will increase reserves. But if the check was cash, meaning, which is the same thing as a Fed paying for the reserves, paying for those bonds with using currency, there's going to be no change in reserves. But the effect of an open market purchase on the monetary base always increases the monetary base by the same amount of the bond purchase. That is always true. I talked about that already. Okay, what about sale? What about an open market sale? Because the Fed can buy and sell bonds. So let's assume that the Federal Reserve, I know I did only one example here. The Fed can sell bonds. Well, it doesn't hurt. Let me do all of them, because at this point, I believe now that you get what I'm doing, how the balance sheet entry is coming up. Let me open a slide, and I do one example. Okay. Okay, so let's say this could be example D. Suppose the Fed conducts an open market sale of $100 million of securities to banks. Then I say, show how these impact the balance sheet of banks and that of the Fed. So this is a bond sale. It's the opposite of bond purchase. Okay. In this case, the Federal Reserve is selling bonds instead of buying bonds. So we want to see how the effect is going to be on the balance sheet of banks. This is Federal Reserve. So again, now in this case, if the Fed is the one selling bonds, traditionally, when you sell something, you lose it. You no longer have that on your balance sheet. So if the Fed is the one selling bonds, they're going to see a decrease in what? Of $100 million in securities. But the banks are the one buying in this case. So the banks, if you buy something, you gain it. So it's the opposite of bond purchase. The signs are going to just flip. So this is going to be plus $100 million. Because when the Fed is selling treasury bonds to banks. Okay? And then all banks in America already have an account with the Federal Reserve called the reserve account. So while reserves are the bank assets, which is their deposit with the Fed, they show up on the Federal Reserve balance sheet as a liability. So when the Fed sells something to banks, banks do not need to write a check or pay for it using currency. They don't need to make any payment to the Fed anymore because they already have an account with the Federal Reserve called the reserve account. Okay, so the Fed is just going to debit the bank's reserve account. So the banks are going to see their reserves account with the Fed go down, their deposit go down by $100 million. And while reserves are the bank assets, they're the Federal Reserve liability. So there's going to be negative $100 million. So look at the balance sheet of the Fed. If the balance sheet of the Fed was balancing before this transaction happened, it should still balance. Why? Because we subtracted something worth $100 million because they sold their securities to the Fed. They don't have it. And then we also subtracted something on the right worth $100 million. So it should still balance. For the banks, when they're the ones purchasing securities from the Fed, they gain $100 million on their balance sheet. And then, but then we subtracted something worth $100 million on the asset side. So each balance sheet should still balance. But in this case, you can see clearly the change in reserves is going to be negative $100 million. It's negative. Reserves have gone down. That means, but we know that the change in the monetary base equals to change in currency plus change in reserves. So reserves is the one changing has gone down $100 million. So that means the change in the monetary base is going to be negative 100 million negative. Okay. And then the second example here is where if the Fed was selling these securities to the non-bank public and paying for it using currency, this is how the balance sheet will look like. So I don't have to draw that. You can see clearly. So the question would be, suppose the Fed conducts a $100 million bond sale to the non-bank public by paying for it using currency, using cash. That's what the balance sheet will look like. So the Fed is the one selling securities to the non-bank public. When you sell something, see, there's a negative sign there, negative $100 million. The non-bank public are the ones buying those securities. So they're going to see their assets go up, their securities go up $100 million. But how does a non-bank public pay for those securities? Okay. How does a non-bank? Oh, I'm sorry, I made a mistake here. The Fed is the one conducts a $1 million to the non-bank public, and okay, that's fine. So the non-bank public is paying for these securities using currency, using their money. So in this case, money supply in circulation is going to go down. The Fed is selling something to the non-bank public, and we are paying for it using currency, using money. So the Fed is withdrawing money from circulation. That's why when we teach you principles of macro, the 2315 class, we say that when the Fed sells bonds, okay, money supply is going to go down because currency is part of money supply. See, currency in circulation is going to go down. It's like the Fed is withdrawing currency from circulation in the economy. Okay, so that's exactly what has gone here. So in this case, the change in the change in currency is negative 100 million. We're assuming that the change in reserves is zero because reserves have not been affected right here. And but we know change in the monetary base equals to change in currency plus change in reserves. So it's this guy which has changed by $100 million negative. So that means the change in the monetary base is going to be negative $100 million. Okay. So that is one of the key, the most important tool of monetary policy that we are going to. I'm going to expand this later in this chapter to actually show you using mathematics, using algebra, that because some of you may ask me, well, if the Fed buys bonds from the banks and monetary base goes up, reserve goes up, so what? Money supply is going to go up. And when money supply goes up, interest rates are going to go down. That's how you're going to get affected, because all interest rates in the economy are connected. Once this interest rate that the Federal Reserve targets, which is called the federal funds rate, once the Fed is able to decrease that interest rate, then you're going to see interest rate on your mortgage going down as well. On your car loan, interest rates might go down. On your student loan. So I'm going to be connecting it to the broad economy shortly. Okay. Connected to the money supply, how that, how this works out. So this is the most important tool of monetary policy, but not the only tool. Okay. So let's look at the second tool of monetary policy out there. So remember, we began with, where did I go? See. Okay. Talk about tools of monetary policy. There you go. So we are done with this. We have been pounding on open market operations, which is buying and selling of treasury securities, because it's the most important tool of monetary policy that the Fed uses. The Fed uses this tool almost about 95% of the time. It's kind of because you ask me, why is the Fed buying bonds? Why is he selling bonds? Because remember, the Federal Reserve influences economic activity. The Fed, using its policy, monetary policy, will influence employment in the economy. They can influence price level movement, inflation in the economy. Okay? So for example, yeah, and we're going to talk about this later. If the economy is weak, where we're in a recession, the Federal Reserve needs to lower interest rate. Then the policy of the Fed would be the Fed is going to buy bonds, okay, to fix the economy. Because when buying bond leads to an increase in monetary base, it leads to an increase in money supply in the economy. Money is going to go up. That's how you stimulate the economy. And then the interest rate would fall. And then, businesses find it easier to invest at a lower interest rate. They're going to hire people back. That's how and then the opposite is true. When the economy is again overheated, where there are fears of inflation, the Fed is going to slow down the economy by selling bonds. When they sell bonds, we've seen that that's going to lead to a decrease in what? A decrease in money supply in the system, in the economy. When money supply decreases, that is going to lead to an increase in interest rates. And when businesses find high interest rate, they cannot easily borrow money to invest. Okay, that's how we're going to slow down the economy. And most Americans cannot borrow at high interest rate because the reason why there's inflation, people are overspending money. How do we slow them down? By raising interest rates. And the Fed will do that by selling bonds. It starts from selling bonds. And then selling bonds is going to lead to a decrease in the monetary base, decrease in reserves, decrease in the money supply, which leads to an increase in interest rates. Because so when Americans see their interest rates rising, they say, wait a minute, I cannot spend a lot of money on a credit card. My credit card interest rate is going to be 25%. I cannot borrow a lot of loans out there because interest. So that's going to slow our spending. That's how you control inflation. So we'll talk about that later on, how that connects to the broader real economy. Okay. So then the second tool of monetary policy, if the Fed is not conducting open market purchase, which is buying and selling of treasury securities, the Fed is gonna do the Fed is gonna loan money to financial institutions. But before I talked about that, where is it? I think I have to go here. Did I pass it? Loans to financial institutions. There you go. So the second tool of monetary policy. Remember, we're saying that the Federal Reserve is a banker's bank. When banks are in financial crisis, especially when the economy is weak, most banks go bankrupt or they refuse to lend. They don't have enough funds to lend, right? So how does the Fed stimulate the economy in that case? So the second tool of monetary policy, we're still discussing tools of monetary policy, which are directly related to the monetary base, is loans to financial, the Fed loans, give discount loans to financial institutions. And charges an interest rate, which we saw in chapter 9. That interest rate is called the discount rate. So anytime the Federal Reserve lends money to banks, the interest rate that the Fed is going to charge banks on those loans is what we call the discount rate. So the discount rate in itself is a tool of monetary policy. Okay, so remember, we have been working with an example. How does the Federal Reserve influence the size of reserves in the banking system and the monetary base? They did that by buying or selling treasury bonds. As for example, if they wanted to increase money supply, they would buy bonds. And now, alternatively, if they don't want to buy bonds, they could loan money to financial institutions. So in this case, the Fed would, instead of buying $100 million of securities from banks, the Fed would just loan $100 million to banks, to financial institutions. So if they decide to loan $100 million to financial institutions, this is how the balance sheet is going to look like. Okay? So a loan by the Federal Reserve is an asset of the Fed. So that's why you're seeing on the left-hand side of the Federal Reserve balance sheet, loans are plus $100 million. I'm not suggesting that when the Fed decides to loan $100 million to banks today, that is the only loan that they have in their portfolio. The Fed already has maybe trillions of loans already given banks, but they're just adding onto the existing loans. But if they loan additional $100 million, that's why we're putting plus $100 million loan. Okay? And then because banks are the ones borrowing from the Fed, if you're the borrower, that is the bank liability. Okay, now this is like similar from me and you. So now I want you to understand this clearly here. Just like me and you, if you have an account with Bank of America and Bank of America approves you for a $20,000 loan, you don't need to go and load that money in a bag and bring it home. That's not how it works. You already have an account with Bank of America. Bank of America is just going to credit your what? Your account with Bank of America with a loan. You're going to see your checkable deposit go up by $20,000. You don't necessarily you have to go to Bank of America and withdraw $20,000 and bring it home. That's the same thing here. All banks in America already have an account with the Federal Reserve called the reserve account. It's just like your deposit, your checkable deposit with your bank, your account with your bank. So when the Fed loans money to banks, the Fed is just going to credit the bank deposit with the Fed, which we call the reserve account, which count as bank assets. So banks are going to see their reserves go up $100 million. So on the left-hand side, assets go up $100 million. But while reserves are the bank assets, they are the Federal Reserve liabilities. So there's a double accounting entry. Transaction enters a debit as a what? And as a credit. Okay? So if the balance sheet of the banking system was balancing before, it should still balance. If the balance sheet of the Federal Reserve system was balancing, it should still balance. But in this case, you can see the change in reserves is going to go up $100 million. Change in the monetary base, which is comprised of change in currency plus change in reserves, is a reserve that is changing $100 million, meaning that change in the monetary base will be $100 million, which are right here. Monetary liability to the Fed is the same thing as monetary base. So these two tools of monetary policy directly impact the monetary base, and eventually the reserve in the banking system and monetary base in the banking system, and eventually they're going to have an impact on the money supply. Because think about it. This money, by the way, come in the form of excess reserves. So if I connect the dot, how will this then increase money supply in the economy? The idea here is that when banks can easily get a loan from the Fed like they've done here, banks now have $100 million in their account with the Fed called reserve, excess reserve. Banks can turn around and lend those funds to we the non-bank public or to corporation. Banks, it's like multiple layers. If it's easier for the American banks to borrow from the Fed, they can easily borrow $100 million. Then banks can extend part of those $100 million to we the public. So we're gonna see money in circulation going up. That's the money supply goes up. Okay. But between the two tools of monetary policy, open market operation and loans to financial institutions, the open market operation is the most important tool. Why? The Federal Reserve has got 100% control over its open market operation. If the Fed wants to buy or sell $100 million, they will do it, whether to banks or to the non-bank public. But the reason why loaning money to financial institutions might be tricky, the Federal Reserve does not have a complete control over its discount loans to banks. I'm going to tell you the reason why. Okay? While the Federal Reserve may entice banks by law, because where would banks want to borrow them? The Fed could lower the discount rate, make the $100 million loan attractive to banks by lowering the interest rate it charges banks. So while the Fed may want to lower to loan them $100 million to U.S. banks, what about if the U.S. banks say, no, we don't want to borrow at this time? That means the Fed has got no power. We are not North Korea. We cannot force American banks to borrow money from the Federal Reserve. The Fed can only entice banks to borrow money from the Fed by lowering the discount rate, this interest rate that it charges banks when it gives them these overnight loans. But it cannot force American banks to take those loans. See the logic here? So that means that the Fed only has partial control over its discount loan policy to banks. It does not control it 100%. If, let's say the Fed wanted to increase reserves in the banking system by loaning $100 million, if banks say no, that means the Federal Reserve cannot go with that policy, because the Fed can coerce banks to borrow from the Fed. That's all I'm saying. Okay, so those two main policies that I'll talk about regardless, they have direct influence on the reserves and monetary base. The other tools of monetary policy, like the Fed, we saw that in chapter 9, the Fed sets a required reserve ratio that a fraction of deposit made in a bank must not be loaned out. Those are not going to affect monetary base and reserve. They will affect the money multiplier. So you got to hold on to those one later. We're going to talk about them later. Okay? Like reserve requirement ratio does not directly influence the monetary base, but it impacts the what? The money multiplier. So you got to hold on to that. Okay, so let's discuss now. Now, there are three, let's talk about other factors that could affect the what? The monetary base. One is going to be float. So float is based on the idea that anytime you write a check, let's say I owe you $500. And I write a check, I give you a check today, I wrote a check today to pay off my debt with you, So I give you handed a check for $500 to you to pay off my debt. So my account is gonna be, I'm gonna debit my account directly. Even though we know that the check, when I give you a check, that's not money yet. The check clearing process take about before that money actually you deposit that check into your account and turns into money. it takes about 3 to 5 business days. So there's a possibility that there's gonna be a mismatch. One account get debited first before the second account, your account gets credited. So that temporary mismatch, where when we are writing checks in the economy, somebody's account gets debited because they've already written a check, they assume they've already paid the debt. But the person who receives that check clearing process might take 3 to 5 business days. That temporary mismatch in the accounts is what we call flow. It can temporarily affect the monetary base. And then I talked about that, the treasury deposit at the Federal Reserve. Remember, I told you that a complete balance sheet of the Federal Reserve include currency. When I talk about liability here, reserves and treasury deposit with the Federal Reserve. And then the assets of the Fed include things that we talked about, it, loans to financial institutions, include the Fed invests in securities. And then the other one was what? We talked about it was the Fed foreign currency reserves. The Fed hold a ton of international currency reserves to intervene in the currency market. So those two can influence what the balance sheet of the Fed or the monetary base. We talked about that already. Okay. Now let's talk about the overview of the Federal Reserve's ability to control the monetary base. Because right now we have seen that there are two policy elements of the Federal Reserve that can directly influence the monetary base. And I want you to pay attention here because it gets sometimes tricky, but it's not tricky. I'm going to break it down for you. Okay. So we know that two Fed policies directly influence the monetary base. You can say reserves and monetary base. And those two policies, what we talk about open market operation. Which is buying and selling. We have been discussing that over and over again. Buying and selling with treasury bonds to either the public, non-bank public, or to banks. And then we talk about the second tool, which is loans to financial institutions. Whether the Fed loans money to banks or buys bonds, all these are going to have an influence on what? On the monetary base. But remember, we said that the open market operation, the Fed likes to use that a lot. That will directly affect monetary base. Because if the Fed wants to buy $100 million worth of bonds, it will happen. Or if you want to sell it, it will happen. But if he wants to loan money to banks, it may or may not happen. Why? Because the decision to borrow will rest with the banks. If the banks say, no, we don't want to borrow, then this policy may have less of an impact on the monetary base. So that means the monetary base can be disentangled. Things that influence the size of monetary base in a monetary base. Monetary base can be written as, let me write it first and I explain what I mean. MBN plus BR. So this BR here is what I'm calling borrowed reserves. And then this MBN, you can call it non-borrowed reserves. Non-borrowed reserves. Or you can call it non-borrowed monetary base. Okay? So the idea, because we know there are two things that can directly affect the monetary base. When the Fed lends money to banks, okay, we know it affects the monetary base, but through borrowed reserves, because the banks are borrowing. When the Fed buys bonds from banks, that is not like the Fed. If the Fed is not lending money to banks, that's going to affect the non-borrowed reserves, this guy here. So whether it's non-borrowed reserve that comes as a result of buying and selling of bonds, or borrowed reserves that come as a result of lending money to banks, either way, they are all positively correlated with what? With the size of the monetary base, with the monetary liabilities of the Fed. And then we can write MBN the subject, make MBN the subject and say MBN, which is a non-borrowed monetary base or non-borrowed reserves, equals to, if you subtract BR from both sides, that's going to be the same thing as total monetary base in a minus borrowed reserves. Okay. That's what you're seeing on this equation here. The non-borrowed monetary base equals to the monetary base minus borrowed reserves. Okay. So that's how we split the monetary base into those two components. Now, let's discuss there's something that I wanted to talk that I might have skipped here, which is yeah. Then I'm going to talk about what influences the size of the money supply. There's what they call a shift from deposit into currency. Okay. I know a couple of years ago, maybe 5-7 years ago, Target reported that Americans who went and shop at Target perhaps had their identity compromised. Somebody stole their credit card information. So let's say we are going into the holiday season, and there's news report saying that, oh, the identity theft has become really bad out there. If you shop with your debit card or credit card, people steal your debit card information and they can withdraw money from your account. You think Americans are going to shop using a debit card or credit card? No. Americans are going to start shopping because we have to go and buy gifts for our loved ones during the holiday season. We're going to shop using cash, because when you shop with cash, nobody steals your identity. So what does that mean? So let's say if all Americans combined during the holiday season, they want to buy gifts, total gifts bought by all Americans, they needed $100 million to do that. But they don't want to write They don't want to write a check or use their debit card or credit card because they fear of identity theft. That means all Americans are going to hit their bank location. Maybe your family might withdraw $5,000 to shop during holiday season. Some families don't have a lot of money, they withdraw only $300. But the combined withdrawals from the banks is $100 million for all Americans because they need cash to go shopping. How does that impact the balance sheet of banks, the non-bank public, and the Federal Reserve? So look, if Americans go and, because Americans are part of the non-bank public, we are part of the non-bank public. This is our balance sheet here. So we go to our bank and withdraw $100 million from our checkable deposit. See, there's a checkable deposit going to go down $100 million. But once your checkable deposit, banks have debited your checkable deposit because you withdraw that money. Americans now have cash at hand, $100 million in circulation. That they're going to be using for buying gifts. How does that impact the balance sheet of banks? We learned that in chapter 9, when a withdrawal has been made in a bank, what we call a deposit outflow. See, banks are going to use their reserves to pay. When you go to the bank to withdraw money, they're going to use reserves to pay for what? That withdrawal. So banks are going to see their assets, their reserves go down $100 million, but their liabilities have gone down $100 million well, because Americans have withdrawn $100 million from the bank. And then sometimes the banks may not have this money. When so many Americans are hitting the bank, they may not have enough vol cash available at the Federal Reserve, at the bank. So they're going to ask the Fed, because all banks have an account with the Fed called the what? Called the reserve account. They're going to say, well, they're going to ask the Fed to print them $100 million. American banks are going to go to their bank, to their bank account with the Fed, and withdraw $100 million. Because the Fed is going to what? Pay for it using currency, give them money, $100 million. If the Fed gives them $100 million, that means the Fed is going to debit their what? Their reserve account. So in this case, there's going to be no net, this idea where people are shifting from deposit to withdrawing money for shopping, the net effect on monetary base is zero, because the monetary base, remember, change in the monetary base equals to change in currency plus change in reserves. Now you see currency has gone up $100 million plus, but reserves have gone down $100 million. So they cancel out. So the net effect on the monetary liabilities or the monetary base is zero. The monetary base is going to be zero. 100 million plus negative $100 million is zero. I forgot to say that. But we have already broken this down, that those two open market, two policies tool of the Fed, affect the monetary base. And so we have to split it that way. Okay. So now from here, I want us to now start paying attention. We are going to start talking about the multiple deposit creation process by banks. A simple model. So how do banks create money in the economy? Banks create money by lending funds in the economy. And when I told you, suppose the Federal Reserve conducts a $100 million bond purchase, how is that going to lead to banks creating more deposit or more money in the economy? That's what we want to talk about today. Now that you know all the balance sheet entries, let's jump in it. So let's go back to what we said at the beginning. We say that suppose the Fed conducts an open market purchase of $100 million from banks, from some bank called First National Bank. Let's just be very particular. First National Bank of America is a private commercial bank. Okay, we just saw First National Bank. So now we know that First National Bank, the balance sheet, okay, is going to look like this. We talked about that already. So the Fed sold $100 million worth of treasury bonds to First National Bank. I know I did not even illustrate. Okay. Let me first illustrate what's up in the balance sheet of the Fed and the balance sheet of First National Bank. We did that already. So this is going to be just simple. We say just a repetition. But we want to see then what will First National Bank do after that. Okay, so this is First National Bank, just abbreviated as FNB. This is Federal Reserve. Okay, so the Fed has purchased $100 million worth of securities. So that means their assets have gone up $100 million. First National Bank is the one selling those securities to the Fed. So they will see that securities go down $100 million. When you sell something, you don't have it anymore. But the Fed is going to credit the First National Bank reserve account, because all banks have their reserve account with the Fed, by the size of that bond purchase. So while reserves are the First National Bank's asset with the Fed will record those reserves as liability. So that's going to be plus $100 million on this side. So we've seen this already. We know that the change in reserves in the banking system for First National Bank, we'll see its reserve with the Fed go up what? $100 million. And then the change in the monetary base is also going to go up. And because monetary base is a sum of what? Currency plus reserve. If the reserve goes up $100 million, then what? Monetary base will go up $100 million. So anytime the Fed conducts an open market purchase from a bank like First National Bank, that money, that initial money, that $100 million that the Fed is crediting their reserves with, comes in the form of excess reserves. Okay? And one of the assumptions we're going to make in this simple model, because we now want to see what will First National Bank do with that excess reserve. So we're going to assume that First National Bank is going to start lending out all that what? All that fund. But anytime we are developing a simple model of money creation or any model in economics, we make simplifying assumptions. So here are going to be two hard assumptions that we're going to put on this simple model, okay? Let's say assumption of simple deposit money creation model. So the first assumption we make here is that we're going to assume that one, banks keep no excess reserves. So in other words, what we said here, once the Fed purchased this treasury bond from First National Bank, the Fed credits the First National Bank reserve account. All these funds come in the form of excess reserve. So since the assumption is saying that First National Bank will not keep that excess reserve, what does that mean? That means First National Bank is gonna invest all that money in the loans market or in securities market. But we're gonna assume for simplicity that they are going to what? To loan all the $100 million excess reserves coming from that bond purchase. That's number one. Then the second assumption is that it's a cashless economy. The public keep no cash. So all your money, all our monies stay with the bank as deposit. It's a cashless economy. These are kind of two extreme assumptions. We know they don't match with reality because in actual terms, banks always keep excess reserves. But we're shutting that channel down for now. But later on, once I develop a complete model of the money supply process, we are going to relax these two assumptions. We're going to allow for the possibility of banks holding onto some excess reserves and the public holding onto some cash. Because we know the Americans who keep cash. If you ask me, do you have money in your pocket? Yeah, I have some $20. Yeah, I'm not a type of person who walk around with cash in my pocket, a lot of money. But there are some Americans who might keep even a larger sums of money in their wallets. Okay, but right now we're shutting those two channels down just to see the complete effect of this bond purchase on what? On the money supply and on the what? On the deposit creation process by banks. Okay, so that 100, since banks are keeping no excess reserve, that bond purchase of $100 million, now the First National Bank now has $100 million in excess reserve. And since they must not keep excess reserve, they're gonna loan out all that money. Okay, so let's see. So First National Bank is gonna loan out. So this is the initial whatever that I showed you when the Fed first what? Bought those securities. We saw that the balance sheet of First National Bank assets, because they sold them to the Fed, but they gained excess reserve of $100 million. Okay, and then so this is gonna be the second stage of the balance sheet, but this is gonna be a lot confusing. Okay, so we're assuming that First National Bank is gonna loan this money out to somebody. Let's say to Jeffrey, some guy called Jeffrey LLC or Jeffrey Company. But it turns out that Jeffrey also has an account with First National Bank. So if First National Bank loan money to you, Jeffrey is gonna deposit that money into the same account with First National Bank. So there's gonna be a new deposit. But this is gonna be confusing. So what we're gonna do is that we're gonna ensure there are multiple banks in the process. So because if I keep using only a single bank, it gets confusing. Because the matter of the fact is that if you get approved for a loan from, let's say, you can get a loan from any bank, even if that bank is not your bank. You can apply for a loan in any bank. Let's say my bank account is with Bank of America, but I can apply for a loan with First National Bank. So if that First National Bank approves me for a $100 million loan, First National, since I don't have an account with them, they're going to ask me, what is your account number with Bank of America and routing number? Then they'll wire that $100 million into my account with what? With Bank of America. So that's why I want to do it that way so that you see what is going on here. So now what I'm saying here, let's open here. I want you to understand this process very well. How banks create money or create deposit in the economy. Creating deposit, multiple deposits is different from creating what? Wealth. Okay, so we say that what? First National Bank, when they sold their securities to the Fed, okay, let's remind you that they lost $100 million here, but they gained what? Reserves of plus $100 million. And since we're saying that banks and this money comes in the form of excess reserves, that $100 million is all excess reserve, and banks keep no excess reserve. So First National Bank is gonna translate securities, it's still negative $100 million. They're gonna loan out all these reserves. So these reserves is gonna turn into loans because the banks must keep no excess reserves. So First National Bank is gonna loan out $100 million. Okay, now we're assuming that whoever picks this $100 million loan does not have an account with First National Bank. Let's say they have an account with Bank A. So let's say this guy is called John or Jeffrey, pick up $100 million loan, or his company was approved for that loan. Okay? But Jeffrey does not have an account with First National Bank. He has an account with some bank called Bank A. So he's going to instruct First National Bank to what? To wire those funds to his account with Bank A. Once that money is wired to Bank A, there's going to be a new deposit, checkable deposit of $100 million in this Bank A. And a balance sheet is a double counting entry. Anytime you deposit money in a bank, this Bank A is going to see its reserves also increasing by what? $100 million. Now, from this stage, this money is no longer excess reserve, all excess reserve. When Bank A now is due, because this is a deposit, the Federal Reserve did not buy these bonds from Bank A. They bought it from First National Bank. When they bought it, whatever proceed First National Bank got in terms of reserve, this came in the form of excess reserve. But now this deposit is creating this reserve. This reserve is no longer all excess reserve. As we said in chapter 9, banks have to keep the minimum reserve requirement. So total reserves that are there, we know that reserves from chapter 9 is required reserves plus excess reserve. We saw this, excess reserve, which we wrote, and let me write for short. Required reserve equals, total reserve equals to required reserves plus excess reserves. We did this already. And we are going to assume that what? If we assume a required reserve ratio of 10%, the little r, which is 0.1. Remember in chapter 9, we're saying that is a relationship. The required reserve, you take the required reserve ratio times the size of deposit. So that means by law, this Bank A must keep $10 million because that's 0.1 times $100 million, which is $10 million as required reserves. Okay? So the balance sheet of this Bank A is going to be changed like this. Of course, there's still a deposit of $100 million, out of which these total reserves can be split into required reserves, which is now $10 million. And then excess reserve would be $90 million. Because if this is $10 million, so you substitute here, this is 10 million, this is 100 million. Well, then you solve for excess reserve. But because we have said that all banks must keep no excess reserve. So first, Bank A is going to translate all this excess reserve into loans. Because that's the assumption we're making in this simple model. The banks must keep no excess reserve, and the public must hold no cash. All the money stay in the bank, in the banking system. Okay, so now let's say there's another individual called Sarah. So Sarah was the one who was approved for that $90 million loan from Bank A. But Sarah does not have an account with Bank A. He has an account with Bank B. So all Sarah needs to do is tell Bank A to wire that $90 million loan, new loan, into our account with Bank B. See how the process is going. So now we have Bank B. Okay, so there's gonna be one Sarah, let me go back here. Sarah was approved for this loan from First Bank A, but Sarah does not have an account with Bank A. He has an account with Bank B. Once she has been approved for this loan of about $90 million, what all Bank A needs is Sarah's account number and what? The wiring information. You know that. The 9-digit wiring information. Okay, the routing number. We call it the routing number, the ACH. And the account number. So the $90 million is going to be wired into Sarah's account with Bank B. So there's going to be a new deposit here in Sarah's account because that's a loan she got from Bank A, which has been wired in her account. So Bank B is going to see a new deposit of $90 million. And we say that immediately money gets deposited in a bank, total reserves in a bank is going to go up by the what? By the same amount of the deposit. Balance sheet is a double account entry. But we know that reserves, which is this total reserves, is a sum of required reserves. You see this in chapters 9 plus excess reserve. The required reserve ratio, required reserve is given as you take the required reserve ratio times deposit. So that means this bank B, out of that $90 million deposit, it has to keep 0.1, which is a 10%, times 90 million. So this bank must keep what? Out of that deposit must keep $9 million. 0.1 times 90 million is $9 million. 90 million. So the balance sheet of this bank B is going to change to, you write this bank B, is going to be deposit is still increased by $90 million. But now this reserve is split into two. See, required reserve is now 9 million. This remember is 90 million. So the difference between the two, that's going to be $81 million. So this bank has got to require reserves from this single deposit. It is going to increase this required reserves by $9 million. That means excess reserves is going to be the difference between the 90 million and 9 million, which is $81 million. Okay? The balance sheet is still balancing because on the right hand left, that is this addition of 90 million. On the left hand side is addition of 90 million. 9 plus 81 is 90 million. And then we said that banks must keep no excess reserves. So this bank B is going to translate all this into loans. They're going to loan it out. Let's say some guy called Patrick was the one who was what? Was approved for this $81 million loan. But Patrick has an account with another bank called Bank what? Let's say Bank C. So after Patrick has been approved for a loan, it could be possible that Patrick also has an account with Bank B, so that money is going to be deposited into his account. But as I say, that is confusing. I want to involve multiple banks so that you see how the process of this, how banks are creating deposit in the banking system. So Patrick is going to say, well, you approved me for an $81 million loan, but I have an account with Bank C. Wire that money to my account with Bank C. Then Bank C is going to see a new deposit going up by $81 million. Okay, and then its reserves immediately, total reserves are going to go up by $81 million. And now you know the drill. So we know that the required reserve ratio is 10%, which is 0.1. So the required reserves, this bank is faced with required reserves. So you take 0.1, which is required reserve ratio times deposit, which is what? 81 million. So this bank must keep $8.1 million as required reserves. Okay, so let me go to the next slide. Let's see how that happens. Okay, so we see, so bank C must keep what? $8.1 million as excess reserve, as required reserves. So this is what is going to be what is happening in Bank C. They still have a deposit of $81 million. Of course, it's plus. You have to put the plus there. But required reserves has changed by what? It's going to be plus $8.1 million. 10% of that. Then whatever remains is excess reserve. So what's the difference between $8.1 million and $81 million? That's going to be $72.9 million. And because banks must keep no excess reserve, that means Bank C is going to lend the $72 million. Now, what you see, up to this stage, if we add the deposit in the banking system so far, it's already way more than $100 million. So when the Federal Reserve bought $100 million bond from First National Bank is going to start lending that $100 million. When they first lend it, they created a new deposit of $100 million. Okay? And then there's another deposit of, the second page, $90 million in Bank B. So we're going to add this deposit, okay, which is $100 million in Bank A. There's a deposit of $90 million in Bank B. That's already $190 million. Then in Bank C, there's a new deposit of 81. That's already over 200, about 200 and what? $271 million. And then we're going to have another deposit of 72 because this is going to be deposited into somebody's what? Somebody's bank. So see, but you see the amount of the money that is being loaned out from $100 million is going down. Eventually, we're going to exhaust all this and this is going to go to zero. But it might require like maybe 100 steps or 200 steps. We're not going to do that by hand. So we can summarize this and see. So at the end of the day, we are interested in knowing how much deposit will be created in the banking system as a whole. From that $100 million what? Initial deposit from what? From when First National Bank loaned out the excess reserve after the Fed had purchased $100 million bonds from First National Bank. Because First National Bank was credited with an excess reserve of $100 million, which they started loaning out. And that's going to trigger multiple lending and multiple deposit in banking, in all banks in the economy. But the question is, once all the process is complete, this is driven to zero. The total deposit in the banking system would have increased by way more than $100 million. In this case, actually, it's going to increase by $1 billion, by 10 times as much, by 1,000 million. 1,000 million is 1 billion. Okay, so but the question is, how do we determine that? So this is a process I was describing. So remember, that was bank A. See, they kept $10 million in required reserves. You can call this required reserves. Then loan 90 million, and then that deposit in banks C. Another bank. See that's in bank B. They kept $9 million in job. They loan out 81 million, and then that was deposited in bank C. Remember? So I really described that. But we can summarize this in this table. What is going on in those balance sheets, in those multiple balance sheet lending? Okay. So here's the beginning is all. First National Bank was the one where the Fed bought the what? Purchase bonds, $100 million bonds. Okay. And then First National Bank lent those funds out, $100 million, because that money came in the form of excess reserve. When the Fed bought $100 million worth of securities from First National Bank, it created its reserves, and that money comes in the form of excess reserve. But since banks must keep no excess reserves, they had to loan all of it. So after they loaned this money to some guy called Jeffrey, we talked about that wrote his company. Jeffrey had an account with Bank A, remember. So there was a new deposit, see, the new deposit of $100 million in Bank A. And by law, Bank A must keep $10 million as what? Required reserves. And then they loan out the excess reserve of what? Of $90 million, because banks must keep no excess reserve. And this $90 million loan was lent to some lady called Sarah. Sarah had an account with Bank B, remember? So they deposit $90 million in her account with Bank B. And then by law, once a new deposit comes to Bank B, they must keep 10% of 90 million, which is 9 million. So Bank B has an excess reserve of $81 million, which they're going to turn into loans because banks must keep no excess reserve. And that's going to be lent to some guy called maybe John. John has an account with Bank C. So there's going to be a new deposit of $81 million. By law, they should keep 10% of $81 million as required reserves. But then they can lend out the other excess reserve, which is 72.9. See the process. So I reach a point where I say it's up to Bank F. Then I put just ... But at the end of it all, when we sum up the total deposit, all these steps, it's going to come up to 1,000 million. That is how banks create deposit or create money. Because remember, in chapter 3, money supply, M1, is a sum of currency plus deposit plus traveler's checks. Traveler's checks, nobody uses it. It's a negligible component. We're just going to say traveler's checks is zero. Nobody uses traveler's checks anymore. So that means anytime the Fed buys bonds, that bond is going to bring excess reserve to the bank that sold the securities to the Fed. And that bank is going to start lending those $100 million. That is going to trigger multiple lending. So we're going to see an increase in a deposit of up to $1,000. But because deposits are part of money supply is going to increase by $1,000 as much. Okay? See, that's loans are going to be increased in the bank by what? 1,000 million or 1 billion. And then the total reserve, required reserves in all the process, what is going to be 100 million, which is basically 10% of the initial $100 million. About when you sum all of them, they're going to add to 100 million. In other words, yes. 10%, so 10% of 1,000 million is 100 million. Okay, so the question is, how do we, because you're not going to be able to do, I put this ... here. This could be 200 steps. You can't do this by hand. You're going to burn out before you go to zero. So we can figure out, how do we figure out how deposit is going to change in the banking system? So there are two ways of finding that formula. We're going to get the formula for that. Okay. So So when you see, so we want to figure out, let me hop in a new slides here. I'll talk about it on the other side. Just bear with me. Okay, so we want to find out the change in deposit in the banking system as a whole. When the Fed bought $100 million bond from First National Bank had $100 million in excess reserve, which they lend all of it. And then some of the other county banks, then that triggered more lending. So we want to figure out how, after all that money goes to zero, the lending process is complete, what would be the total amount of deposit that have been created in the banking system as a whole? So that's going to be change in deposit. That one notation for change in deposit. So you're going to take the $100 million, that's the initial, that bond purchase. And that also created a first initial deposit, because once First National Bank received $100 million in excess reserve from the Federal Reserve after the Fed bought $100 million worth of securities from them, they had to lend all those funds. So they're going to, whoever pick up those $100 million add a new deposit in their bank of $100 million. So that's the first initial change. One here, I'm going to explain, plus 1 minus the reserve ratio. First of all, I want to make sure that, okay, let's got it. 1 minus the reserve ratio plus 1 minus R squared plus 1 minus R to the power 3 plus 1 minus R to the power 4. So this is going to continue up to 1 minus R to the power n. Okay? So whatever you see formula you see in parentheses here, this is what we call a geometric progression series. A geometric progression series is any series where any two consecutive members of the series have a common what? A common ratio. If I take the first two members of the series here, 1 and 1 minus R, and get a ratio of 1 minus R divided by 1, that gives me 1 minus R. If I take the second two consecutive members of the series, which is 1 minus R squared, divide by 1 minus R, you get 1 minus R, because it's going to cancel that. I'll take the third, the second, and the third, and it's, so they're all going to give you a common ratio. There's a common ratio between any two consecutive members of the series. Then the series better be called what? See, common ratio 1 minus R, a geometric progression series. So there's a mathematical way of summing what is in that parenthesis, the sum of a geometric progression series. I'm gonna write that for. But before we do that, what do we have? Why do we write this thing in bracket like this? Remember, if I distribute this 100 times 1, that corresponds to the initial deposit that was made when First National Bank first loaned the what? $100 million to some bank called Bank A. That came on, and then the second deposit is what? How do I get the $90 million? Because once they pick up this loan, whoever pick up this loan, First National Bank is going to loan that money, $90 million, which is going to end up in Bank B. There's going to be a new deposit of $90 million. So how do I get $90 million in this second state? See, so what I'm going to do here, 1 minus R, remember R is the reserve ratio, which is 10%. That's going to be given to you in the problem. That's 0.1. So 1 minus R here is 0.9. 1 minus 0.1 is 0.9. So if I multiply $100 times 0.9, that is the $90. Then you get the third member of the series, 1 minus R squared. We know now 1 minus R is 0.9. So this is the same thing as 0.9 squared. 0.9 squared is 0.81. So if I multiply 0.9 squared, which is 0.81 by $100, you get the third deposit that we talked about. See this deposit here of 81, you're actually showing up in this summary. You get that $81 million the new deposit. How do I get the $72.9 million? So that's going to be the fourth member of the series. This is, remember, 1 minus R is 0.9. So this is going to be 1 minus R to the power 3 is 0.9 to the power 3. So 0.9 times 0.9 times 0.9, trust me, is the same thing as 0.729. 0.9 to the power 3 is 0.729. So 0.729 times $100 that's going to be $72.9 million. So now you can see, so this replicates what you see, those multiple deposit creation process. But now, the sum of the geometric progression series, because the geometric progression series, whatever we have in parentheses, the 1, 1 minus R, whatever, there's a common ratio. So we know the common ratio is 1 minus R. So in mathematics, in algebra, or in arithmetic, a geometric progression series, whatever junk you have in that bracket sums to 1 divided by 1 minus a common ratio. And the common ratio is 1 minus R. 1 minus R. There you go. So whatever you have in parentheses here is basically 1 over 1 minus R. But this is based on the premise that this R has to be a number that is bounded between 0 and 1. That's a condition. Otherwise, if it's not, then the series becomes explosive. It's not going to sum. Of course, our R is a reserve ratio. Reserve ratio is always what? It's always less than 1. Okay, it's 10%. The fraction that the Federal Reserve wants bank to keep is not going to exceed 1. It lies between 0 and 1. Okay, so now, so now, then we finish it. So then that means change in deposit is going to be equal to 100, initial $100 million. Put the sign million there. Inside 1 divided by 1, the denominator is, you distribute is 1. If you open this bracket, 1 minus 1 is going to be 0. Then there's a negative sign here. This becomes positive R. So you're just going to remain with 1 over R. Okay, so if I open my next slide, and summarize that, you're going to see that this is actually very exciting. We're here. Okay, so that basically means that we're saying that the change in deposit equals to the $100 bond purchase or initial deposit times 1 over R. This is a formula that I want. But if you ask yourself, what is that $100 million? That is the initial bond purchase. When the Fed purchased $100 million bonds from banks, what is the immediate effect to the bank balance sheet? The change in reserves will go up by $100 million. So this $100 million, so you can, in general, you could just write this as delta D must equal to change in reserves divided by, times 1 over the reserve ratio. That's the formula that we're going to be using to figure out, when I say, suppose the Fed buys $100 million worth of treasury bonds from banks. If the reserve requirement is 10%, what is going to be the total change in deposit in the banking system as a whole, which is coming to 1,000 million or 1 billion? Or what is the overall change in the money supply? How do we get this $1 billion? You use this formula. So remember, the Fed purchased $100 million of bonds. So if I know that, we know roughly from First National Bank, they bought this from First National Bank. So First National Bank sold their securities to the Fed, so we debit their security, but they had a reserves. Reserves went up by what? At the initial stage, by $100 million. We did this. So the change in reserve is $100 million. But so if I give you, if the reserve requirement is 0.1 or 10%, then the change in the deposit in the banking system is going to be, you plug this one, $100 million multiplied by 1 over, R is 0.1. Don't write 10. 0.10% is, you write it in decimal. It's going to be over 0.1. Okay? So the change in deposit is going to be 1 over 0.1 is 10. So 10 times 100, that's going to be $1,000 million or 1 billion. So that's how deposit is going to change in the banking system. Okay? Okay, I derived this formula that we just derived for figuring out how the total deposit in the banking system would change. And you need to remember this formula. I'm never going to ask you to derive a formula in this class, but you need to understand them so that when you forget, you can derive it yourself. Okay? There's another easier way of deriving this general formula that we can use for figuring out how a total deposit in the banking system might change. if the Fed purchased or sold bonds. And we're going to do an example. So let me, the second way to derive this is to recognize, so we know that what? Okay, let me open a new slide here. We're going to derive the same formula, but yeah, another easier way without going through a geometric progression series. Okay, so we know that what? We know that total reserves in a banking system is given as required reserves plus excess reserves. We know that's true. But remember that one of the assumptions, remember, we're saying that banks keep no excess reserve. That was the assumption we made here. So if banks, by assumption, if banks keep no excess reserve, that means this excess reserve is going to be zero. So the total reserves in the banking system is just going to be equal to required reserves. But what is required reserves? We know that required reserves, you take the required reserve ratio times deposit. So I'm going to substitute this guy here. So that means my total reserves is going to be equals to the required reserve times deposit. Because required reserve is the same thing as what? As R times D. So I'm just going to substitute R times D for RR. Then I come up with this. So this is similar to, like, remember R is fixed by the Fed. It's a fixed number. The Fed sets and say 10% of total customer deposit must not be loaned out. So that's a constant. So if I write you equation, if somebody say Y equals to, it's kind of similar. This equation that I'm writing is similar to what you know. If somebody say this is like a side note, what is wrong with pen? Pen is not acting up a little bit here. Okay, so your side note here. If we say Y equals to 2x, 2 is a constant. 2 doesn't change. So that means what brings changes in Y is x. So you can write this as delta Y must equal to 2 delta x. Yes. Delta means change. So the change in x is going to bring change in y. It's going to be the same thing here. I can write, because I know the r, I know r, this little r is like 2. It's a constant. It's fixed by the Fed. So that means I can write this as delta r is going to be equal to r times delta d. Then I can make delta d the subject by dividing both through by what? Divide both sides by little r. If I divide both sides by little r, you're going to get delta d equals to 1 over little r times change in r, which is the same formula that we derive with the what? With the geometric progression approach, right? We found it here. That's the same formula. Okay, so now there's a special name that we give for because this is a simple model, simple deposit creation model. There's a special name that we give to that. Okay, so let me do. So this is a formula you need to remember. So we're saying delta D equals to 1 delta R times 1 over R. Remember this formula very well. This 1 over R is what we call the simple deposit multiplier. How do we define that? Simple deposit multiplier. What's the definition of that? So this simple deposit multiplier is the number of times an initial deposit made in a bank multiplies itself to generate the final change in total deposit in the banking system as a whole. What it is. So for our simple example here, when you think about it, let's go back there again. But let me go and do another example. Just how you would apply this, how the question would look like. Okay. Let's do an example here to clear up everything so that you get to see how to apply it. Okay, so example. Let's say, suppose the Fed purchased $50 billion of securities from banks. Then A, show using the balance sheet